what they call DeFi insurance, which is focused a lot on DeFi on a project-by-project basis for specific types of losses. We're taking a much broader approach to the insurance, similar to how you'd expect traditional insurance to operate. Much broader approach, and then extending that far beyond just DeFi and into just crypto holders in general that are holding their assets in cold storage, hot wallets, or even exchanges.
Hey guys, Keeper here from CryptoSlate. Today I have with me Brandon Brown, one of the co-founders of FairSide, a really interesting new insurance platform. How are you doing, Brandon?
Good. Thank you very much for having me.
No, you're welcome. Thanks for joining us. So let's get straight into it. So how does FairSide differ from other insurance platforms that people may be familiar with, kind of like the Nexus Mutuals or the InsureTechs of the world?
Yeah, there's a few different ways. I think the biggest way is that the way we're approaching the insurance product in the space. So we're a subscription-based insurance alternative. So we're offering users an annual membership to protect their crypto portfolio for the events such as theft or exploits. And those are going to range from everything from smart contracts, exposures, and exploits all the way into personal wallet attacks that happen to users. So that's a very far cry from where you see a lot of the what they call DeFi insurance, which is focused a lot on DeFi on a project-by-project basis for specific types of losses. We're taking a much broader approach to the insurance, similar to how you'd expect traditional insurance to operate. Much broader approach, and then extending that far beyond just DeFi and into just crypto holders in general that are holding their assets in cold storage, hot wallets, or even exchanges.
Yeah. So, like going through the website, you say that there's no, I think the word used, that there's no policy wording to hide behind. So, I mean, how does that work then? If there's no policies, like for people that are used to getting insurance, you get a policy, you get insured for something. If there's no policy, so I don't know what I'm technically insured from, what am I protected from?
Well, you'd have a membership agreement that will describe the types of losses that we cover, very specifically what we're covering. And then we really don't need to exclude things because we're going to be very definite in what we are covering. But ultimately what happens is the DAO in advance is approving certain types of losses. So if the DAO approves smart contract failure, flash loan attack, governance attack, stablecoin debugging, or could be anything, phishing attacks, whatever it is, whatever the DAO is already approved, we take a different approach because we're not actually going to vote on individual losses of our members. We vote on the event. Is this event what we intended to cover? If the event is what we intended to cover, this is a flash loan, this is a smart contract failure, for example, then there is no need to vote on individual losses. All the member has to do is provide proof of loss that they were part of that exploit, and then their payouts would happen via smart contract. And so, just removing the idea of, most insurance contracts have more exclusions than they do coverage language, right? We want to focus on what we're covering in very simple form, more like a blog post, like, hey, these are the things we're covering. We don't need to get into all the things we're not covering. This is a DAO, it's discretionary cover. But if we become very specific about what we intend to cover, and then we have a lot of those things that we're covering, the cover is very comprehensive in that way.
So walk me through how that kind of governance prop might kind of work then. So for instance, let's take probably one of the most obvious events, which is like say the UST DPEG. I know a lot of the platforms went off a VWAP price over a period of time. So, and that's where a lot of them differed. So it's like, okay, the price needs to be below the peg on the VWAP for 2 or 3 weeks. So I can't remember exactly which platform it was, so I won't say because I get it wrong. But I know some took longer to pay out than others because they had to wait for the average price to follow suit. If an event happens, can one of the members sort of just say, hey, I feel this is an event, I feel this is what we were planning to cover, we should pay out to anyone that can prove that they've had loss at this time?
Yeah, we would create thresholds around what types of losses that we cover and how we cover them. Like, for example, we'll get to the USDT depegging, but the types of losses, need thresholds around them. So, for example, if you want to cover smart contract failure, then we would say, okay, we need to have, 2 public audits from whitelisted group of auditing firms, right? And so then the DAO approves the whitelisted group of auditing firms, and then if your project has that, since we're approaching the insurance differently, We're chain agnostic. So we're like, I always call us any chain cover, where we cover multiple cover types for multiple chains for multiple different projects. And so, as long as you are dealing with a project that is legitimate and has done its due diligence, has its smart contract audits, then we recover smart contract failure for any project on any chain. If it's a stablecoin depegging, we would look at something like, algo stables are a little tough, and that's been proven, right, that those aren't that stable in holding their peg. So, we would have to look at something like collateralized stablecoins that have depegged, and if they've a collateralized stablecoin depegs below a certain amount, and it could just be for a certain number of days. It doesn't need to be like a time-weighted average, right? It could just be literally, if it drops below this, does not regain its peg within a certain amount of time, then that would be covered. Now, that is something that actually doesn't even need a DAO vote, because you can do that with parametric models. Like, there are guys like playing around with that idea right now. But outside of something that has an absolute answer to it, like a stablecoin depegging, things that have more nuanced types of claims events, they still need a governance vote. Things like, is this a smart contract failure? Is this what we intended to cover? Yes, it is. But we approach it differently because we're not backing project by project. So if you're just backing MakerDAO, the stakeholders create a very high correlation of their assets and the risks they're meant to insure, like the failure of MakerDAO or smart contract failure. That creates a concentration of risk that is pure, and then it leads to stakeholder liquidation as the means of providing insurance. That is like, that one-to-one correlation is closer to a betting mechanism, and doesn't really create the social and economic good. It's closer to a zero-sum game. So you need something that has a diversified approach so that stakeholders can enter the network, and not, we don't look at the stakeholder like we need to liquidate the stakeholder in order to provide insurance. I think one of the missed aspects to an insurance model, and that's where, a lot of our team's background comes from the insurance sector. What's missed is that the assets that are placed into a staking pool are meant to be risk-based assets in order to float the system until the premium that you charge is fully earned on an annualized basis. So insurance companies or insurance schemes, they always look to charge a proper premium so that the premium that you charge is slightly higher than the losses that you pay out on an annual basis. And when you can achieve that, the system becomes resilient over time. And the assets that are there allow you to offer more and more cover, and then float any losses that occur prior to fully earning or annualizing the premium. And that's like a big miss, I think, on a lot of the insurance projects that you see in the space. They all look to the risk-based capital as they intend to liquidate those stakeholder assets. Liquidation of a stakeholder asset is not how an insurance model has been created in the past for 300 years to become resilient. We can't keep relying on stakeholders to fall on their sword and ask them to keep coming back to the well to drink more water just so we can liquidate you again. That model will not be sustainable and will not last for very long.
So you talk about shared loss, I believe. So so how does that then work? 'Cause I feel like that sort of ties into what you're saying.
Yeah, so we pioneered what we call network staking, and at the surface, at its just core level, network staking is the ability to stake the entire network in just one staking function. You stake or bond your ETH to our capital pool, and it mints an FSD token. The FSD token itself acts as a sort of synthetic to the capital pool, whereas there's more and more Ethereum deposited, then the price goes up and down. And there's pricing formulas to that allow the system to ultimately monitor its own solvency and remain resilient. And so when there's an immediate need for capital in the pool, the pricing algorithm will kind of change up or down related to, the stakeholder incentives or how we want to incentivize stakeholders either to purchase more or even possibly sell off. Capital at rest in the system is not a good thing either. So you might intend to just say, we want, the price is moving too high. We have too much capital in the system for the amount of potential cost sharing that exists. So we need to, incentivize people to sell off. So when you get too much, incentivize to sell off. And when you get not enough, it incentivizes people to purchase.
Interesting. So with this sort of shared model, especially say with the governance side, is there any risk of kind of abuse if it's a community deciding what should be paid out? Like, is there risk there that someone could kind of simulate events and then get enough people together in order to manipulate it?
Well, there's a lot more economic value gained in the system by performing honest votes. So when you consider having one large capital pool and a diversified approach, since we're not backing the projects, we're backing the network. So we can offer all this cover, and then you get members who come in for 1,000 different projects that they want cover on, not just one or 100, right? Where you've isolated the risk. And so what occurs in the system is you're able to basically create fractionalized losses across the entire network. So as you're holding that FSD token that's synthetic of the capital pool, what occurs is these fractional decreases in value when you pay out claims. But the fractional decrease in value is much less than the value of the rewards being earned on an annualized basis. So you have more economic value and incentive to vote fairly and create a healthy network than you would ever to try to manipulate the vote to not pay out when the losses are minuscule in your holdings, because it's spread across the entire network.
Yeah, I was kind of thinking of the reverse in terms of trying to get the pool to pay out for things that aren't real, as opposed to the opposite.
Well, we're a conviction-based DAO, so basically the longer you hold the FSD and the more time, so the amount of FSD you hold, the longer you hold it, creates a conviction score. So you basically you're voting your conviction score in the network. So based on that, it's your percentage of conviction versus the global conviction score of the network is what you vote. And so it's very difficult for someone to come into the system and control a large enough percentage of the conviction score to sway the system one way or the other, especially if you're, say, for example, someone who has suffered a loss recently wants to enter the system, buy a bunch of FSD or bond a bunch of ETH to mint the FSD, and then say, okay, I'm going to outweight this vote. There's a waiting period on the amount when you can vote in the system. There's ultimately a 10-day waiting period to stop people from trying to manipulate the vote.
And doing exactly that, I guess, as well. Yeah. So there's no kind of risk of like flash loans or anything being used to sort of manipulate token pools and things.
Yeah.
So you've kind of touched on this, but I just want to go through it. So there's a 4% fee, I believe, correct? So I can get, say, 100 ETH protection for 0.4 ETH. So how does that work, though? Like, just trying to help kind of like the everyday user understand, how can you protect that amount of collateral in Web3 for such a small fee? Because ultimately, like, that seems like a really great deal to me. Like, I'm really interested personally.
Yeah, we're actually even trying to make it a little bit more tailored to each individual user, where we're going to start to bucket. So initially, we talk all about DeFi users, right? Because there's a lot of need in the DeFi space for insurance, flash loan attacks, smart contract failures happening all the time. But there's an equal need in the space for individual who just either trade or just sit and hodl. Like, those people have, they're subject to phishing attacks and social engineering all the time. So what we're looking at doing is kind of breaking that model apart and saying, okay, we'll have one bucket. As you sign up for coverage, you can choose, do you want cover for DeFi? Or do you want cover for personal wallets? Do you want cover for custodians, right? And we're going to break that out to even make it a little bit more user-friendly and ultimately less expensive, because the 4% model is meant to ultimately allow us to build up to, continually adding coverage within the network without having to change the premium model too much, because we work off of an actuarial model, which we believe is the most sound from an insurance perspective in order to constantly be able to adjust the rate based on actual loss experience. The wisdom of the crowd or collateral utilization that you see a lot of projects using today doesn't really have the same capabilities to do that, because, for example, wisdom of the crowd, right? If I have the more staking that occurs for a particular project, it's deemed to be more safe. But it doesn't change the probability of a loss that something happens to one of these particular projects, and then it's very difficult to alter the premium later on because people could just stake it again, and then you put the stakeholders at risk again. So using true actuarial models, we'll be able to come in, alter the premiums based on the loss experience that we have. So we'll be able to come in with that 4% model and say, okay, here's the goal. You might choose 2 buckets and get to the 4%, and that might get you all DeFi and all personal wallet protection. We're going to launch with DeFi protection first out of the gate, and then quickly right after that, move to launch the personal wallet protection as well. So hopefully we can get those rates down a little bit for each different bucket.
That's really interesting. So rather than like the competitors where the buckets are the projects, your buckets will be like the niches within DeFi. I think that really makes a lot of sense to me in that my thinking around DeFi especially, but I guess it's kind of just Web3 and blockchain in general, is that through the decentralization model and decentralized ownership, we're also taking on a lot of the risk as well as all the rewards. So banks have bank enterprise level security that costs an absolute crap ton to get it to work, and is very complicated, and there's lots of sort of fail safes in place, but it's very centralized, and therefore they make all the money out of it. For me, the way that I'm seeing DeFi evolve is I see a world where we can utilize these like raw platforms that allow us to earn the money rather than the big banks to earn it. But we still need that security layer. We still need, and for me, I'm thinking of a system where, and this way, what you're saying makes a lot of sense. We need to go out there and find different tools that suit our own risk platform, risk matrix. So there's apps like say DeFi Yield app that we've done quite a lot of work with. I really like what they're doing because they allow you to quite easily understand what's happening with the smart contracts, whether they've been kind of exploited, what the risks are involved with that, and being able to kind of put extra protection. You've got multi-sig wallets, you've got all these different things you can do, which may cost money, may cost resources, but it's the kind of payoff between that and traditional banks. So do you see that as being kind of the future for you in terms of DeFi, is that we need kind of a common, like users can select almost the middlemen that they want to help them stay safe, and projects like you would obviously be quite a core one because you're insuring all of that stuff?
Yeah, I mean, insurance is a financial primer of all industry, right? So without it, you don't have lending and borrowing, banking, building, construction. Nothing lasts without insurance, no matter what the sector is. Financial markets rely on it equally as much as other physical markets do as well. So crypto is no different, right? We need to have that financial base layer, that primer that everyone can rely on, and then allowing you to come in and choose what type of cover that you need. I think it's very akin to the traditional markets that you're used to. Like, you buy insurance on the things that you want for the types of risks and exposures that you face as an individual. So I think that's no different than the crypto user. They're going to want the same thing. And I think that when you create this layer of cover that is very something that there is relatable to the current insurance that you're buying, I think that you are able to usher in a whole new wave of retail crypto investor, DeFi user, everything, right? Insurance kind of gives everyone that ability to sleep well at night. And I think you need that in all spaces. And I think that that's where we really fit in. And I think we're, by approaching the insurance very differently and not just focusing on the DeFi user, but focusing on all crypto holders. We're not DeFi insurance, we're crypto cover for everything that you need. So once you have, one FairSide membership, and we have launched all of our buckets of cover types, all other insurance protocols ultimately become obsolete at that point. There's just no need for anything else when you have everything in one. And you can do that when you start to use the traditional aspects of insurance, and you bring them over, adaptations of the traditional insurance sector over to the blockchain. That's really never been done before. And when you do it, which we have done, and we've been working on this for years, you actually create a whole new layer of a next generation of DeFi cover, which is this blanket coverage, this approach.
Could you see off-chain coverage coming into this, like paying a fee and I can insure my house, but I pay an ETH as a premium?
Yeah. So, okay. So, we're going to conquer DeFi insurance first and crypto insurance second. And then I think that after that, there's lots of use cases for what we've created. You could get into flood, crop, when you start to get into like things that require litigation, liability insurances, and things like that, they're a little bit stickier. But yeah, moving into off-chain, honestly, looking at like personal wallet protection, even though you can see the things on-chain, there are aspects off-chain that we need to pull in order to verify that someone's not, simulating this hack for insurance fraud purposes. But we've got a pretty good system that we're developing right now to do that. So.
Yeah, I'm really interested in that. And I think, like, again, trying to onboard people from Web 2 to Web 3, if there's a system where you can say, okay, well, it's really complicated, I don't get it, but I can just get an insurance in case I screw up. Protecting you kind of your parents from getting those emails that they think, oh, it was from Binance, it was real, and it's just a phishing email.
Yeah.
I think that's really fascinating, approaching that. So what drew you to DeFi? If the team's kind of from a traditional insurance background, what brought you to sort of DeFi and blockchain in general?
Yeah, so there's a few of us from the insurance sector. Mid 2017, or actually it was early 2017, mid 2017, I got pretty heavy into investing in crypto. Coming from the insurance space, that's my experience is 12 years in the insurance business. I wanted to insure my crypto and couldn't do it, and that was like the light bulb for me. I'm like, I understood what this space was and where it was going, and knew that there would be a need for insurance products, like readily available insurance products in the space. And so I just flipped the switch and said, this is what I have to develop. And so I've been working, I know it sounds like a really long time, but been working on it ever since then, developing different concepts, because you know, in order to adapt insurance principles into the blockchain, it's not super easy to do. And then you have to have a sustainable model that can handle the DeFi risks and the other crypto risks that that users experience. And so we've been building for a very long time, designing, iterating, and until we really settled on something that is like nothing that anyone's ever seen in the space. And that honestly, you know, when you consider, like, there was a big narrative for a while there that was talking about, like, you know, protocol owned liquidity and all this other stuff. You know, the reality of protocol and liquidity is it's the insurance model, right? You charge a higher premium than you intend to pay out on losses. And then over time, you start to build your own liquidity within the network, which then just honestly just drives yield because you have more capital to offer cover. And then it just kind of becomes this snowball effect. And so, yeah, it's definitely a different way to look at it. But when you start to do these things, like we look at crypto insurance like a blue ocean right now.
Yeah. So, I mean, I completely agree. And so what's next? When does the DApp fully go live? And you're saying you're starting with DeFi?
Yeah, we're going to start with DeFi since we, you know, already developed, you know, that side of and this is a retail-driven product right now. So retail, you know, the models have been designed to be high frequency, low severity. We intend to pay out a lot of claims to a lot of people on a low severity amount, maxing out cover at 100 Ethereum. And then once we, you know, kind of move into the personal law protection, and then we'll move in after that, we'll move to protocol cover. So, you know, I see a universe where you have coordination of benefits between the retail side and the protocol side. You know, if you look at some of the protocols and the amount of total value locks that they have, it becomes cost prohibitive to insure that much capital. So you have to look at this thing twofold, right? We're going to have protocols that have cover, and we'll have retail that has cover, and they'll just coordinate benefits between the two. And that's sort of like our next push after we launch all the forms of DeFi and crypto cover that we want on the personal or the, let's say the investor side or retail side, and then we move over to the protocol side.
Sorry, did you give a date of when?
Oh, sorry. Yes. So we're targeting Q4, end of Q4,
cool,
for everything to be ready to go. Yeah, we've undergone. I think we're moving into our 6th audit, so we're auditing this thing to the nines. You know, can be a lending and borrowing.
So kind of one of the things I was thinking, you were saying that all other insurance platforms will become obsolete. Maybe all they need to do is provide insurance against you guys getting exploited.
Yeah.
Like insurance, because I was speaking to some of the insurance guys before, and they were talking about I think definitely that is one thing the industry can do, is kind of insuring each other. So I think, maybe that's it. You make it so that they only have one product and it's you.
Yeah. So, yeah, I definitely think
7 audits.
That's actually not a bad plan. Yeah, 6 so far. So yeah, we're the 6 will start next week. So we're you know, you can be a lending and borrowing platform. You can have an exploit. People have short-term memory loss. You fix the bug, they come right back to it. I think as an insurance, you know, or it's an insurance alternative, you know, I think you really need to have the layer of, you know, a security that at the highest level. So that's why we've made some really strategic partnerships with some of the most amazing security firms. One being, you know, Halborn Security. We love those guys. They're our full-time security advisors, and it doesn't really get any better than them. And the advice that they give us and the audits that they do for us are just top notch. So, yeah.
Fantastic.
We're taking it pretty serious, yeah. Taking it pretty seriously.
I'm really interested. It sounds like a great product. I'll be checking it out as soon as it's available to go live myself. Say personal wallet coverage actually is the part that I'm quite interested in. Just give you kind of that peace of mind to play about in the world of Web3 and connecting your wallets to different apps and such. I've been having a lot of fun in Web3 social on kind of the Lens protocol ecosystem this week, and the amount of different dApps my wallet's connected to right now does make me slightly nervous. So it would be nice to have an extra little bit of cover, and the very like not have to have like burner wallets. Do you know what I mean? Where you're feeling like, right, okay, I need to make sure that I've only got X amount in this wallet just in case, and all this sort of stuff. Like you remove the need for that, and I love that.
Yeah, we'll allow users to connect up to 3 wallets as well. So 3 wallets, portfolio cover, So that'll allow you to, be able to have, wallets on Avalanche or Polygon, ETH, Solana. That way you can, cover your basis as you're moving between different projects and blockchains.
What about we say multi-sigs?
Yeah, multi-sig's good.
Yeah, but how many? So if I've got a wallet that's got say a 2 of 3 signer on it, so technically there's 4 wallets there. Would I need to add all 4 wallets to an insurance, or could I just insure the multi-sig, or have you not got that far yet?
Well, we haven't really dissected that as much, but at initial glance, I would say it would be the multi-sig is what you'd be after, insuring the multi-sig for the 100 ETH. That makes the most sense.
Cool. That could work as a really cool way. I'm very interested. Yeah. Brandon.
Yeah.
Yeah,
the nice thing about what you described is, you've got the multi-sig with, the 100 ETH and cover, but then you still have the 100 ETH and cover that can go to 2 other wallets that, you might be, so if you're worried about your signer wallet, then you could do that as well.
Yeah, that's what I'm saying. That's pretty cool. I like it. Okay. Well, thank you very, very much for your time. Super interesting. I'll be keeping an eye out. Q4, FairSide going live with the DeFi stuff. And I wish you all the luck with the launch.
Yeah, thank you so much. I appreciate you having us. Awesome.
Yes, thank you. Okay guys, that's the end of the video. Thanks for watching to the end. It really means a lot. If you're interested in watching more content like this, subscribe to the channel. It doesn't cost a penny. If you could like the video, it really helps it get out there in terms of the algorithm. I know everyone says that, but it is true, unfortunately. And leave comments below about sort of what content you'd like to see next, who else you'd like us to interview. We've got a massive Rolodex of people. We're trying to find really interesting projects and getting a different angle for you guys to get some insight into the industry. You can follow us on Twitter, so at CryptoSlate, or myself, I'm at KeepItBlade. And obviously the website where the majority of our content is CryptoSlate.com. So go there now. We have a membership, which is called Edge, where you can get insights, data, exclusive articles, some really great stuff. And there is some cool stuff coming up with Edge for Edge members in the not too distant future. So check it out. And until next time,